This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This is the second lecture on the chapter on the capital asset pricing model. And the reason I split it into two, partly I didn't want the lectures to be too long, but also because we're going to bring in something extra here, which is the gearing. And you should already be clear from, again, earlier exams that gearing, well, you should know what it means. Gearing is the level of debt borrowing there is in the company. But the more gearing there is in a company, the more risky it is for the shareholders. And so nothing directly to do with what I was saying about systematic and unsystematic. It's a systematic risk that we're worried about. But the more gearing there is in a company, it increases the risk. So you might have a company where if there's no gearing at all, it's got a beta of 1.5, twice as risky as the market. But then if the same company is geared, the shares become riskier still. And the betas that are published are the betas of equity. The beta of equity, or what we call the equity beta, that measures the risk of the share and one of the reasons, or one of the things that makes shares more risky is the gearing. It measures the risk of the share, including the effect of the gearing. And before hopefully I'll make that clear with some numbers, do remember that the basic rule applies that the equity beta, the beta of a share, still determines the return that shareholders require. So, okay, a share may have a beta of 1.8. That 1.8 is what we use in the formula to work out the return on the share, the cost of equity. But the reason it's 1.8, part of the reason, would be because of the level of gearing in the company. And the reason that can matter, I'm going to look at two examples. The first, a very simple little one to make the point, and then a rather more important one. Look at example 5. P has a gearing ratio, debt to equity, of 0.4, and the beta of its shares is 1.8. So the risk of the shares is 1.8, but part of the reason it's 1.8 is because of the gearing. Another company, Q, has a gearing ratio of 0.2, and the beta of its shares is 1.5. So again, it's 1.5 is the risk of the shares, but part of the reason for that beta is because there's gearing. And the question says, first of all, which is the more risky share? Well, there's no argument. Whatever the reason is, the higher the beta, the more the risk. So A, the more risky share is P, because the risk of its shares is 1.8, and that's greater than the risk of Q shares. But B becomes more interesting. It says which company has the more risky business activity. You see, P share is more risky. Is it because P is in a more risky industry? P's an oil company and Q are accountancy firms or something? Or is it simply because P has higher gearing, there's more debt involved, so you'd expect P to have, for the shares to be more risky, for the shares to have a higher beta? And so to find out how risky the business itself is, we need to calculate what the beta would be if there was no gearing at all. If there was no gearing at all, both shares would be less risky. They'd have lower betas. And if there was no gearing at all, the beta then would be purely measuring the risk of the business. And so we need to what we call ungear the beta. We need to work out what the beta would be if there was no gearing. And there is a formula in the exam, which again you should have seen in the previous financial management exam. There's a formula given which looks far worse than it actually is. I'll explain why when we come to it. But you've got the formula typed there. Let me type it and then explain what the symbols are. Beta A is VE over VE plus VD 1 minus T times beta E plus VD over VE plus, VD 1 minus T over VE plus VD 1 minus T times beta D. Now what the symbols mean, beta A is the asset beta or the ungeared beta. And that's the beta if no gearing. Beta E is the equity beta or the share beta or the geared beta. That's the beta of the share itself, which I've already said includes the gearing effect. Beta D is the debt beta, the beta of the debt borrowing. Now, I did say earlier, you'd expect that to be low because debt has much less risk. It's fixed interest. As far as the exam's concerned, we always, just for this formula, we assume that debt is risk-free, only in this formula. But if debt is risk-free, we'll come back to the previous lecture, its beta would be 0. So that bit of the formula in the exam always becomes irrelevant. Finally, VE and VD are the market values of debt and equity. I'll let you guess which is which. T is the tax rate. So let's look back to the question. We already know P is the more risky share. It's got the higher equity beta. But as I've said, to determine which is the more risky business they're in, we need to take out the gearing. We need to calculate what the beta would be if there was no gearing at all, i.e. the asset beta. So let's do it. First of all, P. The equity beta is 1.8. The gearing, well, I did say those things in the formula, VEVD, are the market values of debt and equity. If the question actually gives you the market values, the total value of equity, so use them. But appreciate, we are effectively only looking at a ratio. And so we don't actually need the market values themselves in this question. It says the ratio of debt to equity is 0.4. So for every 100 equity, debt must be 0.4 of it, debt must be 40. So it's only that ratio we're going to need. So I don't care whether you use 140 or 280, the answer would end up being the same. So let's now apply the formula. The asset beta is VE 100 over VE 100 plus VD times 1 minus T. Well, the tax rate here is 30%, so times 0.7, times the equity beta of 1.8, which comes to 100 divided by 100 plus 128 times 1.8. It comes to 1.40625. I'll leave it like that, but I did say in the exam generally, just round it to two places, 1.41. Which is lower, obviously. Of course it's lower. Take out the gearing, things become less risky. That beta is what the beta would be if there was no gearing at all, would be purely measuring the risk of the business itself. What about Q? The equity beta of Q is only 1.5. Its gearing, well, if equity is 100, debt is 0.2, they're giving it as debt to equity, so debt would be 20. And so again, let's use the formula. VE 100 over VE plus VD times 1 minus T times the equity beta of 1.5. So Q has an asset beta of 1.316. So I hope I've made it clear. We've stripped out the gearing. Those betas are the measure of the risk of the business itself. And so to answer the question, which has the more risky business activity? Well, again, in fact, it is P at 1.4 as against 1.3. But I hope you see what I'm getting at. The only way you can be sure which has the more risky business, or is the more risky business, would be to remove that gearing effect to look at the asset beta. All right, well, that's how we use the formula. But when this is relevant in the exam, and it's very, very common, this gearing and ungearing betas, comes really to when we look at project appraisal. Just look at the example, and I'll use that to explain what the problem is and how we approach it. X plc is an oil company with a gearing ratio of 0.4, and shares in X have a beta of 1.48. They're considering investing in a new operation to build ships, and they found a quoted shipbuilding company Y. Y's got a gearing ratio of debt to equity of 0.2, and shares in Y have a beta of 1.8. Now, why is that relevant? The relevance is this, that X currently is an oil company, and it's geared and fine. Its shares have a beta of 1.48. That's partly because of the gearing, partly because they're investing in oil. But they're now thinking of investing in an operation to build ships. Well, surely what matters, if they're going to use shareholders' money to invest in building ships, we need to know how risky ships are. They might be more risky than oil. Building ships might be less risky than oil. But it's the risk of building ships that should determine the return we need. And so I need to know the riskiness of shipbuilding. What's the beta for shipbuilding? And the only way we can find out is look for a similar quoted company that builds ships. And we found one. Y is a shipbuilder, and its shares have a beta of 1.8. Well, I want to know the riskiness of shipbuilding, and of course the only problem is that although Y shares have a beta of 1.8, it's a geared company, and so part of that beta is due to the gearing. And so to find what the riskiness of shipbuilding is, as always, I need to work out the asset beta. That'll tell me how risky shipbuilding is. And so we're going to use the formula again. The gearing, debt to equity. So if equity is 100, the debt is 20. The tax rate here is 25%. And so what's the asset beta for Y? Equity 100 over equity plus debt times 1 minus T. 25% tax, remember? Times the equity beta of 1.8. Y has an asset beta 100 divided by 115 times 1.8. 1.565. So fine, what is that? That's the beta of Y if we remove the gearing effect. That is the riskiness, the beta of shipbuilding. And why do I care? It's because X is thinking of investing in shipbuilding. I don't care how risky oil is. Whatever they're currently doing, they're thinking of investing money in building ships. And so the return they need depends on how risky building ships is. 1.565. And so it says, what discount rate should the appraiser new project at if it's going to be financed entirely from equity? Now think about this rather than purely learn a rule. At the moment, shareholders are invested in X, it's oil, and all right, the beta's 1.48 determines the return they want and so on. But they're now being asked to invest more money in ships. It's financed entirely from equity, it's shareholders providing the money. And if you're investing money in shipbuilding, if you were doing it directly in a shipbuilding company, the return will be determined by the riskiness of shipbuilding. Okay, here the company's investing the money for you, but you're still giving them your money, and your money is being put into shipbuilding. And so the return you need from the shipbuilding bit, this new project, is determined by the beta. The required return it's the normal formula. It'll be the risk-free rate of 8% plus beta 1.565 times the market premium 18 is against 8, which is 23.65%. And therefore, when we come later to actual net present value calculations, to the discounting, for this one, when they were appraising this new project, you would discount at 23.65% because that's the return shareholders would want of their money for investing in ships. Don't panic, you wouldn't in the exam be asked to actually discount 23.65 because it's not in the tables. You may well have to do this exercise, but it would end up with a rate that is in the tables. What about part B though? What return do we need from the project if it's to be financed by equity and debt? 50-50. Now it's the same project and we know how risky shipbuilding is. But if half the money for the project's coming from equity and half's from debt, then we actually need to work out a weighted average for the project. Half the money is going to be becoming cheaper because it's debt. Half the money will be more expensive because it's equity. And so we're going to have to work out a weighted average. So first of all, what about the cost of equity? Well, we know if equity was providing all the money, they'd want 23.65% return. But here, part of the money is coming from debt. It's like a little geared company on its own, this project. And this little geared project, if there's debt in it, it's more risky. The beta will be high, the required return higher. We're going to have to use the formula again. We treat it as though it's a little company all on its own. 50% equity, 50% debt. We how risky it is. We're going to have to work out what the beta of the equity would be in this little geared company, and therefore the return equity would need. So we're going to have to use the formula backwards. We know what the beta, if there was no gearing, is 1.565, the asset beta. But there is gearing. The gearing is 50% equity, 50% debt. And so, using the formula, the asset beta that we know would be equity over equity plus debt times 1 minus t times the equity beta, which is what we're trying to find out. And so using the formula backwards, beta equity is equal to 1.565 times, well, 50 plus 50 times 50 times 0.75 is 87.5 divided by 50. The equity beta would be I get 2.74. I'll keep to 2 decimal places. And so, much higher beta, because part of the money for the project is coming from debt. In fact, quite a lot of the money for the project is coming from debt. It makes it more risky for shareholders, a higher beta, and therefore there'll be a higher required return. The cost of equity, normal formula, risk-free 8 plus beta 2.74 times the market premium, which is 27.4. I mean, enormous, obviously. 35.4. It's getting a bit ridiculous, but still. So as a return, shareholders would want for their money being invested in this project. What about debt? Well, you know how to work out the cost of debt normally, and if it's redeemable debt and so on. We've been through all of that. Here, though, we're not given any information, so all we can assume, and it's an assumption, is that it's risk-free. I said before, debt has much lower risk, but in real life there is some risk. But if debt is risk-free, investors would be requiring the risk-free rate of 8%. But remember, although investors would want 8%, the company gets tax relief, 25%. The net cost would be 75% of 8%, which would be 6%. And so, viewing this new project as a little company all on its own, what overall return does it need to give? It needs to give 35% to shareholders on their money. It needs to give a net 6% to debt on their money. Well, the overall return, the weighted average, normal, weight by market values. So 50% equity at 35.4, 50% debt at 6%, the weighted average, (20.7%). So that's the overall return. This project views the little company on its own. That's the overall return it would need to generate. And so later, when we come to setting up cash flows and so on, to appraise, you would discount at 20.7, 21%. Now, think about that, please, and watch that again if you need, because gearing and ungearing betas is very, very common in the exam. Never as an entire question, but certainly question 1 in the exam is always testing lots of topics in the same question, using capital asset to get the cost of the money, setting up cash flows, discounting. And I say I can only do each bit, lecture on each bit separately. But do make sure you can use that formula and you are clear what's happening. Lastly, though, as I have written in the notes, in fact, Part B is unlikely, and the reason is that when there are big changes in gearing, there's an alternative approach which is much easier. Well, I don't know, we can argue all day whether it's easy or not, but there's an alternative approach which is regarded as being a better approach, and if there are big changes in gearing, it's normally what the examiner expects and actually asks for, and it's something called adjusted present value, which, as you'll see when we come to it, would not involve doing Part B the way we've done it. We'll still need Part A, you'll see why, and so make sure that you are happy with the formula, but as I say, it's just Part B, which is much less likely in the exam itself. Good, there we are.